Thank you everybody for being here and for your continued interest and support in the project. And in particular, I wanted to start by thanking some of the familiar names that I see on the Zoom who belong to our focus group. People like Andy Kaufman, Mo, Etienne from DeFi Pulse, Oleg from CoinRule, Cerny, Matthijs, MCD. All of these people made significant personal time available to us to review early versions of what you're about to see. And without their help, we just wouldn't be here today. So seriously, guys, thank you so much. And also before we start, I want to say that we really, truly are committed to making this a community-first protocol. And I don't know if you noticed, but we didn't publicize this event much on Twitter. And the idea was that we wanted to share this announcement with our core community members first, before we actually release to the wider public. So once again, to all the people on this call, our OG community members, all that we built it for you guys. So we really hope that you'll like it. So here's the agenda for today. We have a lot of really exciting stuff to go through. We're going to be sharing 3 big announcements. First, we're going to be disclosing new information about the Kelly curves. We actually started touching on this in our prior call, but now we have a fully completed model. And we're also very excited to make an announcement relating to Potion Analytics, which is a suite of analytical tools that will help LPs make sound risk decisions. Secondly, we will also be showing you the now completed and audited Kelly machine, which is a Web3 implementation with native support for Kelly curves, as you will see. And finally, we have a bit of a surprise, which is that we're actually going to ship a 3rd piece of code, which we're calling Potion Unlock. And this is the mechanism by which we're going to transfer the protocol to the community. It's a radical new approach that we are pioneering, and we're incredibly excited to share with you guys today. So without further ado, let's get into it. We're going to start with the Kelly curves. And I want to go back to our beginning. As some of you may remember, we came together in Hack Money just about a year and a half ago. This was right before the DeFi summer, and there was like a special energy in the air and excitement. We were just being blown away entirely by the emergence of incredibly cool new technology all over the place. And in particular, one thing that caught our imagination was this new primitive architecture, so-called AMM, or Automatic Market Maker. And the big idea with this technology was that LPs could, for the first time, deposit collateral into a pool. And that pool would enable, on the other side, people to trade assets in a way that didn't require an oracle. So there was some mathematical magic that allowed users to basically be able to buy things priced directly through this new device called the bonding curve, which is this very elegant mathematical tool to price assets without requiring an oracle. And so what we wondered was, could we actually use the same principle of a bonding curve, but instead of using it to price asset swaps, use it to price risk? A bonding curve that would allow an LP to put collateral in a pool and enable risk applications such as insurance, puts, calls, and generally any derivative in such a way that it was also responsive to risk, that you could rely on the smart contract to manage the risk such that the LP would not go bankrupt, which seemed to be a challenge yet to be resolved in DeFi. And I'm really excited to say that I think we found such a bonding curve, and this is what we're going to be going through in a moment. But before we do that, I want to go back to some of the basic concepts that we discussed already in our first call, which is why didn't we use Black-Scholes? And after all, Black-Scholes is kind of the industry standard in finance for pricing risk. But it turns out that Black-Scholes makes some pretty hard assumptions about the nature of the assets And those assumptions may happen to coincide with the reality, but sometimes they don't. And that is particularly true for crypto assets, which happen to be very fat-tailed. And fat-tailed means that these assets have very extreme returns sometimes that Black-Scholes basically assumes never happened. And when they do happen, in reality, what happens is that LPs face the risk of going bankrupt. And to illustrate some of these limitations for Black-Scholes, what you have on screen is a Monte Carlo simulation for 3 assets that have identical volatility. So from the perspective of Black-Scholes, which is a single parameter model, there is a single price for these 3 assets. But it turns out that these 3 assets actually have a different mean of their returns. So they are equally deviate their returns, but they have different means. And what you can see is that the one that has the high mean in green has almost like unreal returns. They have very low risk and very high return, which suggests that you're probably overpricing. You could probably price a little bit lower and you would still be making a profit. And on the flip side, what you can see is that for the asset that has the negative mean, it's the opposite. Black-Scholes is completely unaware of the mean. It just takes volatility as an input, and therefore it fails to price this appropriately, leading LPs to bankruptcy in most cases. This is particularly relevant in crypto markets that are, as I was saying, very fat-tailed. And so we really needed to find an alternative to this model if we wanted to achieve our goal of sustainable risk management in DeFi. But not only that, it turns out that Black-Scholes is kind of limited to pricing calls and puts. So if you want to do something a little bit more fancy, you either need to combine those things, which can be a little bit complicated, or you're out of luck. The model just basically does with these 2 fundamental instruments. And finally, the mathematics involved with Black-Scholes are pretty complicated. And the state of the art right now in Solidity and Ethereum is that a lot of those mathematicals were very complicated. So it was just basically not something that lent itself well to on-chain implementation. So that's why we turned to the Kelly Criterion. The Kelly Criterion was developed by John Kelly, who at the time was working with Claude Shannon, who you may know as the father of information theory. And these guys developed a different approach to risk-taking. And that approach fundamentally linked 2 things: the amount of capital that you're going to bet as a function of your entire bankroll, and the amount that you should expect to make in return in the long run. And in this chart, we're looking at a coin toss. The coin toss is kind of the standard mathematical example when looking at statistical problems. And this is a biased coin toss. So you win 60% of the times and you lose 40% of the times. And if somebody was to ask you, how much would you bet? Like if somebody offered you a bet on a coin toss that was biased, in which you had an actual edge, how much would you actually bet? And the result is very non-intuitive, because you might say, well, because I have an edge, I'm just going to bet all. I'm just going to bet 100% of my bankroll. And as Kelly is showing you, this would be an incredibly bad idea. You may be lucky the first time, you may be lucky the second time, but if you continue betting 100% of your bankroll, eventually you're going to lose. And when you lose, you're going to lose everything. And so your mathematical expectation of return, in spite of having an edge, is 0. And so using the Kelly criterion, what you can find is whether there is actually an optimal bet fraction out of your entire pool of capital that does lead to positive returns. And in this case, it turns out that if somebody was to offer you a 60% coin bet, the optimal amount to bet is 20%. That's actually the amount to bet that guarantees the highest maximum growth. I also want to highlight that Kelly is not concerned about optimizing a single bet. He's interested in your long-term compounding, which is exactly what we wanted to deliver for LPs. We were not trying to optimize the return for a single bet exposure, but rather optimize for long-term risk exposure, continuous bet and risk taking. So what you see on the chart on the right is also a coin toss, but this time this is a fair coin toss, so it's 50-50. And what we're introducing is the notion of a premium. So in this case, the market maker will actually be charging a premium in order to take the bet. And each of these lines represents a different premium. So the bottom one would be 2%, and the top one would be 37%. And you can see two things. You can see that for some premiums, there is no utilization. It doesn't matter whether it's a low or high util, the premium is just not enough to give the LP an expectation of growth, right? So these are all premiums that you should discard. So right away, it's giving you the functionality of filtering out the premiums that lead to ruin versus the premiums that lead to gains. And the other thing that you can see is that for each of these premiums, the optimal betting amount is different. You know, for this one, which I believe is 34%, like if you're charging 34%, you should, like the optimal bet would be around, 18%. Whereas if you were to charge 37%, then because the odds are better, because now you're charging a higher premium on the same risk profile, Kelly's telling you can actually bet a little bit more. Like the odds are more favorable, you should bet a little bit higher. And here came our first big idea. Could we actually use the Kelly criterion backwards? So normally Kelly answers the question, when offered a risk scenario, what is the optimal betting amount? Could we actually use this the other way around? Could we say, if somebody asks me for a risk instrument that is going to take 20% of my pool of capital, can I use it to say, I'm going to charge you this amount. I'm going to charge you the 34%. And if somebody comes and asks me for a 30% of my current pool of capital, then I'm going to charge 37%. So you see, this is different to what Kelly was initially intending, but it actually allows you to tune your premiums to always be within optimality conditions. And so the next thing we did was to, instead of working with coin tosses, we decided to apply these to put options and call options. And what you're seeing on screen now is exactly the same chart that we were looking a moment ago, but for an insurance, 100% insurance on Uniswap of 1 day duration. And once again, you see that there are some premiums here that don't have any positive expectation regardless of the utilization. You then also see that there are some premiums that don't have a maximum. They almost like diverge up. So in some sense, Kelly is telling you should actually take a loan. You should leverage. This premium is so good that you should actually put more than 100% of your capital. And then we see these premiums in colors. And these are really special premiums. These are premiums that have a local maxima. So you will see that the maxima in the blue one is here, in the purple one is here, in this pinky one is here. These are Kelly optimal conditions. And what we thought was, this is super interesting that Kelly kind of organically selects for like market selling points. It selects for a happy medium for buyer and seller. So the seller has this expectation that they're not going to go bankrupt, but the buyer also knows that they're not being taken advantage of. You know, it's not like the seller is pricing with one of these that are ridiculous. It's almost like this happy neutral medium for buyer and seller. So that got us really excited. We thought maybe this is the bonding curve that we were looking for, because for the first time we could establish this relationship between premium and utilization. But we had a problem, which was, how do we store that on chain? Are we gonna like literally build like a database in a smart contract where we're kind of gonna write for each possible utilization, which is a lot, you know, potentially infinite, their premium? And so that was a big challenge. And that's when I think we had our final breakthrough, which is that we realized that if you actually put together all these local maximas, all these Kelly optimal points, they actually come together in a really beautiful and elegant, simple mathematical equation, which is x times the hyperbolic cosine of x with some parameters. And for us, like when we saw this, it really was an indication that we had stumbled upon something potentially meaningful and that we were on the right track. You know, like when you find something this simple and this clean, it kind of suggests that it is true. And so in some sense, I think that was the first time when we thought, I think we cracked it. We resolved our dream. We finally found a bonding curve that can price risk, you know, in the same way that Uniswap pioneered xy equals k as a way to price swaps, now we have a really simple mathematical way to price risks. And it's really interesting because it's designed with survival constraints, just like I mentioned. Like at the core of this formula is this positive expectation of returns. It's really nice because it's very efficient to implement. I can have infinite resolution with only 4 parameters. And not only that, but it's actually fully generalizable. And I want to spend just a few moments on that point. So let's actually compare Black-Scholes versus Kelly on these 3 parameters: the information model, the payoff structure, and the actual pricing curves. So for Black-Scholes, you just don't get to choose the information model. It's constrained. And it's constrained to a normal distribution, and you cannot play with a mean. The only parameter that you get to play with is volatility. And if everything else is wrong, it's kind of tough luck. With Kelly, you don't have such constraint. In fact, it's fully generalizable. I can assume that it's Gaussian. I can assume that it's a Laplace distribution. I can assume that it's a power law. I can assume that it's a t-student skew distribution. I can also take an empirical distribution. I'm not forced to take the model that is embedded in Black-Scholes. And this basically does away with the problem that you cannot price fat-tailed assets with Black-Scholes. And with Kelly, you can. The other big difference is that with Black-Scholes, as we said, you can price calls and you can price puts. And then you can price combinations of calls and puts, but that's it. With Kelly, you have this flexibility that you can implement a call, a put, or any function. In fact, I could come up with the world's craziest payoff function that had like a parabola here and maybe something else here. And price would tell me that's your bonding curve for it. It's kind of not constrained to that payoff structure, which is incredibly exciting. And finally, there is another major difference, which is that Black-Scholes completely ignores how much value are you putting at risk. Whereas with Kelly, the result of this combination is a price curve that is a function of the value at risk, which, by the way, kind of stands to just basic intuition. If I'm putting at risk 80% of my capital, if I was to lose, that has massive implications for my ability to actually build up my capital again. So it stands to reason I should be charging higher in that scenario than when I'm only putting 10%. Black-Scholes completely ignores that factor, whereas with Kelly, that's almost like the primary factor. It's the number one thing that Kelly wants to know. How much of your capital are you putting at risk? Because if you're putting a lot of capital, you better be charging a high premium. So with this hyperbolic cosine, what we have is a very beautiful mathematical answer for how to derive this optimal bonding curve. Let me show you what this translates into in terms of actual results. In this chart, what you see on the x-axis is maximum drawdown for a battery of Monte Carlo simulations for, I think it's 100 assets that we're testing here. And these assets range from crypto assets to currencies, to commodities, to equities. Basically, we went for a very diversified set of instruments. And we also chose different market regimes. We went for bull runs, bear runs, lateral markets. We try to capture like a broad range of different assets and a broad range of market conditions. And in red, what you see is the performance of Black-Scholes. So we actually took the exact volatility. We're not trying to estimate the volatility, but these were with perfect volatility estimation, the results that Black-Scholes produced. And once again, you can see this very inconsistent performance. Sometimes for some assets, under some circumstances, LPs go bankrupt. And by the way, this is at 50th percentile. So that's kind of the mean, the average result. They go fully bankrupt. And sometimes they almost go off the charts in terms of positive results with no risks. And notice how in blue you have the results for these assets being priced with these Kelly optimal curves. And you see this really nice result that I think demonstrates the premise that we were just talking about a moment ago. Kelly manages to price it such that it stays just above zero. It's finding the premium that leads to almost like a market neutral. And it also manages to capture the risk of the asset. The higher the risk, as in the higher this goes to the right-hand side, the more the drawdown the asset produces, the higher the return that Kelly kind of brings forward. So once again, this was kind of confirmation that we had stumbled on something that was in fact working. I mentioned that this was going to be one of the announcements that we're going to make today, and I'm really excited to introduce you to Potion Analytics. this is a set of tools that we have built to help LP do a number of things. So we're going to have an interactive white paper. So it's going to be different to the other white papers in the sense that you're going to be able to play with the charts. So you're going to be able to choose different assets and different insurance levels and different strikes and different durations, and hopefully develop like a more natural intuition for how is actually Kelly working under the hood. You know, why is it pricing the way it is? We also have a benchmarking piece that's going to allow you to compare it with Black-Scholes side by side. And more importantly, it's also going to allow LPs to actually design their own bonding curves. And I'm not going to have time to go into this now, but as you will see a little bit later in the presentation, in our model, unlike Uniswap, each LP has their own independent pool of capital. And LPs will have the flexibility of choosing their specific bonding curve to reflect their bespoke risk-reward preferences. So with this tool here, you're going to be able to design those curves and get a kind of natural intuition for what's the risk that you're going to be taking and what's the reward that you should be expecting. I would actually love to go a lot deeper into that, but in the interest of time, we're going to leave this here now. I just want to leave you with this idea that Uniswap pioneered this simple ability to price swaps, and that with Potion, we're trying to extend that same model to the realm of risk. And we're incredibly excited about the opportunities that can unfold from this. We think that risk management on chain in DeFi is a really important function that is still yet to mature. And hopefully with this discovery, we're one step closer. With this, I want to hand over to Aureliano, our beloved CTO, who's going to be talking about the Web3 implementation that we did for this model. Over to you, Aureliano.
Hey everyone, GM. I'm going to walk you around two fundamental products that we've designed and built with huge effort and passion. We should be new to most of you, except maybe the people that help us testing them in the focus group. First, I'm going to introduce the smart contracts that we've built to accommodate these Kelly Criterion bonding curves and the architecture of a Potion protocol in general. And second, I want to talk to you about the Web3 user interface for the contracts that we've prepared and the UX principles we've used in it. So first of all, let me quickly walk you through the flow described in this chart. Hopefully this will give you a high-level idea of how the basic mechanics of the protocol work. Step 0, liquidity provider or LP comes to the Potion liquidity smart contract, creates a personal pool and deposits stablecoin collateral in it, a deposit that he's somehow expecting to grow through accruing trading fees. Here, it's super important to highlight that every LP has his own separate pool inside the Potion liquidity contract that he can set and control trustlessly and individually, increasing the security of LP operations. Next step, a buyer comes to the liquidity contract wanting to immediately acquire a given insurance policy, sending the corresponding premium. And at this point number 2 in the chart, the liquidity contract automatically locks part of the LP's pool collateral in a separate escrow smart contract. This contract will custody now the insurance collateral until the expiration date, and then at expiration, the contract can be settled using a Chainlink oracle that determines the corresponding payouts for the buyer and the LP. Like if underlying asset goes down, buyer gets a payout. If it goes up, LP gets his collateral back to the pool. Here it's worth highlighting two general things. First, we've chosen Opin as an integration partner for our escrow and settlement contracts. Opin have been specializing in creating these smart contract vessels that are very good for escrowing and settling derivative products. And in this sense, in our V1, we're only using put options, but Opin has already built the infrastructure that would almost effortlessly allows us to use call options and spreads using the same liquidity from Potion LPs in a future B2. And second, and more generally, this modular architecture allows us to use anything as an escrow contract, really. We could use an optimistic oracle from UMA, for example, or a custom settlement contract with new exotic logic designed by us or by any third party, really. Okay, let's now zoom a little bit into the liquidity smart contract that controls the LP pools, and let's check in more detail how it works internally, why it's so amazing. Let's follow again the flow in the chart, starting from point zero. So a buyer will come to the LP's pool and ask for a quote on a given insurance policy. For example, please give me the price of 2 at-the-money put options on Bitcoin expiring in 30 days. The LP smart contract will then measure the utilization of or current value at risk of that LP and find out a quote through the bonding curve embedded in the contract. And what's really nice here is that this is a self-contained automatic process. The LP contract doesn't need to consult any oracle to provide a quote. Once the buyer sends the quoted premium to the contract, the LP contract will automatically take the necessary stablecoin to fully collateralize that insurance required. In this example, say $100,000, moving that collateral into the escrow contract. Then at settlement, the LP will receive back part of that collateral if the insurance doesn't pay out to the buyer. And when you put all of this together, what you get is an autonomous machine that does automatic fee accrual for the LP, right? By selling risk instruments in an AMM. And what's most crazy and beautiful is that all of this is done for the first time in the history of DeFi, really using the Kelly criterion for algorithmic risk management on chain. In addition, LPs can edit the settings such as the instrument sold, the bonding curve of their personal pool, and they can do it at any time, adding and removing unlocked collateral at will without depending on other LPs. Okay, so as we have said, every LP has his own pool, but when a buyer comes to the Potion protocol, he's interested in getting the cheapest premium possible for whatever insurance he requires, without caring about the complexities of, thousands of individual LP pools. So for instance, if the buyer wants to lock $100,000 of collateral for his insurance, it's very unlikely that the cheapest way to get it is to ask for it to one single LP, because that would increase the LP's utilization massively, producing higher premiums. So instead, it would probably be better to split the order across several LPs and just ask for small chunks of collateral to each of these, lowering the aggregated premium in the process. To determine the optimal order split and allocation, we've built the Potion order router, an algorithm that does exactly that. But most importantly, it does it taking into account gas costs in the process, so that gas consumption is also optimized. And what's really beautiful about all of this is that effectively the buyer will be interacting with a giant aggregated pool that prices options according to what we call the emerging bonding curve, the market aggregated bonding curve computed by the router. And in this sense, Potion follows a peer-to aggregated pool trading model. So finally, an important mention, all the Potion protocol smart contracts were audited by Consensus Diligence and an audit done earlier this year and passed with flying colors. Yeah. Okay, so we already went through the first more technical thing I wanted to show you. Now let's go for the second part, where I'll show you some eye candy corresponding to our fully developed Web3 app accompanying the Potion protocol. I'm not going to go full depth here. The app is profound and has many features, and we're going to provide a specific blog post for it, and we're going to do community demo calls around it in the next few weeks. As I said before, there are two sides on the Potion protocol: the insurance or Potion buyers and the liquidity providers. Each of the sides have their own section in the Web3 app. So let's get started with the buy side, shown in the snapshot you see below. The main point I want to convey in this slide is that we have included two coexisting user flows. One that is all about the buyer having full customization over the insurance or Potion that he's buying. Let's call it the expert flow, where you can set up the asset you want to insure, whatever strike you want, whatever duration, etc. The other flow is all about easy to use, convenience, speed at buying. The second flow basically allows the buyer to see what are the hottest, most used, most collateralized Potions already existing in the protocol, and in a single click, they can purchase insurance from the pre-cooked Potion of their preference. So another quick point related to the buyer side that I want to bring to your attention is the gas saving feature. So anytime a buyer is, for example, dwelling on the custom potion flow as in the snapshot here, he will be getting live recommendations about similar potions that already exist on chain, and he can buy those at any point again with a single click, and he will be saving very significant amounts of gas in the process. So let's jump quickly into the LP side of the app. Here we also have two coexisting flows again, one for advanced LPs that want full customization of their personal pools, and another that is all about easier and quicker experience where less sophisticated LPs can still set up their pools with just a few clicks. So starting from the custom LP flow, you can see that advanced LPs are facing two important decision steps before deploying their pools. The first step is about setting their instruments that the LP will be selling insurance for with a stable coin collateral of his pool. There's a crucial feature worth highlighting, which is the fact that Potion LPs will be able to serve multiple markets simultaneously with the same pool. That will yield levels of capital efficiency that we don't think are offered anywhere else, really, in the main LP protocols out there in DeFi right now. So the next step is as crucial as the previous. Now the LP needs to set up the bonding curve that will be used on chain to provide premium quotes to buyers that come to the pool. And setting a winner bonding curve can be regarded as a bit of an art, but it definitely also requires a ton of science to do it right. And as Alpha Block mentioned in the previous section, Potion Analytics will have you covered on the science end and will give you advanced LP tools that will be necessary to come up with the right curve for your pool. Regardless of how LPs come up with a bonding curve, that being through our Kelly approach or some other custom proprietary method that LPs may have. In this screen, the LPs can input the desired bespoke curve, and they can compare it with a market aggregated bonding curve I was referencing when talking about the router before. That's super cool because it will allow the LP to see if his price is close, far, above, below the current market pricing. Okay, so I'm closing. Well, I'm close to finish now, but let me give some more color on the more entry-level LP flow. This flow is based on the idea of social trading. Since all protocol data is obviously public in Ethereum, our subgraph can index all of that and show it in useful ways to the LP and help him deciding how to set up his pool. So for instance, we show the LP the pool configurations that are currently being most used by other LPs. He can also see pool configurations ranked by those that currently have the larger amounts of liquidity in them. Or finally, he can also browse pools ranked by their historical performance. That is, those pool configurations that have yielded the largest P&Ls in the protocol so far. So imagine you're one of those LPs discovering the most popular pool configurations out there. Hopefully you will quickly find out one that suits you well. And with just a couple of clicks, you'll be able to deploy a pool on chain using exactly that configuration. And worth noting that this newly created pool will totally be independent from other pools currently using that same configuration. So finally, closing the UX sneak peeks, let me just briefly mention that we've worked a lot to create a powerful subgraph that indexes all data, as I was saying, related to the Potion protocol. And that allows us to digest that data for the user and show it in the UX. This way, LPs will be able to see real-time performance data on their own pools, and on those pools discovered on social trading section, and they'll be able to make better decisions. Okay, so I've covered a ton of stuff on our Web3 implementation in a little time. Let me conclude with three general remarks, take-home messages. One is that we've built a Potion protocol in a way that can natively support Kelly bonding curves. And we've built a DeFi marketplace for people to trade risk products based on the pricing of those curves. Second, this Potion protocol has been thoroughly tested for a long period and carefully audited. So we believe it's ready to use. And finally, thanks to our incredibly talented design and front-end team, we built a human-centric UI that is sexy, it's easy to use, and at the same time exploits a bunch of very useful, very powerful features. So yeah, we're really happy with that. I'm passing it over now to Alpha Block, who I believe has this exciting, fresh, juicy news about When Token.
Thank you so much, man. I actually want to add myself to the recognition to the front end team. These guys worked incredibly hard, and it wasn't an easy thing. I think this was the first project that we're launching in DeFi, and I think perhaps we're a little bit too ambitious. We didn't build really an MVP, but like a fully featured product in the end with a lot of customizability and functionality. And I've told the guys a million times, but hats off to you guys. You did a crazy good job. So now let me transition into how is this going to hit the market? We've seen the mathematical grounds for the Kelly optimal curves. We've seen the implementation, but how do we release this? And this was a problem that was bugging us for a long time. If you've been following the news, derivatives protocols are kind of the most risky DeFi space from a regulatory standpoint. And so if we take a look at how most protocols operate today, you will see that the result is massive amounts of liability for the founding members. So this is the normal setup. There is a group of devs. They set up a multi-sig. And from this multi-sig, they basically do a whole bunch of stuff. They deploy and operate the contract. They issue a token. And then they use that token to perform the initial treasury deployment of the protocol that can be used for liquidity mining and other marketing activities like this. A part is sold oftentimes to private investors that are going to front the money to help the project get off the ground. And then the devs actually give themselves some allocation to kind of be aligned with the future success of the protocol. And to be honest, like this is not such a bad model. Like it worked, but I think it raises some concerns. One is if we're trying to build something that is truly a new paradigm in terms of decentralization and moving away from all the power being concentrated in the hands of the few instead of on the hands of the many, is it really the case when you have just a handful of people actually controlling the protocol? And then the other one is when you're issuing this token, you immediately inherit a lot of problems related to securities law. So I think for us, the summary is this doesn't seem like a sustainable method for the ecosystem. I don't think we can rely for the next 10 years on this model for DeFi to flourish. I think we need to find a solution that protects the developers and allows them to do their best work without being fearful for whether they'll end up in jail. And we actually spoke to a number of regulators in Europe and several law firms, and they actually scared us quite a bit. You know, the penalties for operating an unregulated derivatives trading venue is pretty severe. We're talking about over 15 million euro in fines and penalties, and potentially 3 years of prison. So this is not a joke. And so we really we're wondering, how do we do this? You know, we want to bring all this knowledge out into the world. We want this to be used. We think it's good for DeFi. It doesn't seem fair that we should put our entire lives at risk, you know? And so we actually came up with something that we call aggressive decentralization, in contrast to progressive decentralization. And sometimes I say that progressive decentralization can be a little bit of an oxymoron. It's a little bit like a progressive pregnancy. Like either you are pregnant or you're not, and either you are operating in a fully decentralized way or you're not, you know? And so let me actually go through like the two main vectors of risk that the teams incur. So the first one is this idea that you cannot operate a derivatives trading venue without a license. And you know, if we go back to the slide, if you are the person have admin rights on the protocol, and it's only 7 people, it's very hard to argue to the regulator, no, this is decentralized. This is it's not us controlling this. It kind of really puts all the liability on the team. So for that reason, we actually propose a different model whereby developers stay clear of deployment and maintenance functions. So they limit their scope of activity purely to engineering and design. The second vector of attack for current teams is this idea of the token issuance, which is at odds with securities regulation. And to avoid that pitfall, instead, we expect to finance ourselves through a different route. But in a nutshell, the point of this thing that we're going to introduce right now is to achieve two objectives. One, to limit the liability that founding teams are taking by working on DeFi. And secondly, still maintaining the ability of this software to see the day of light. So let me get into Potion Unlock. We've been working on this for a few months, guys, and you can't imagine how excited I am to share it with all of you. And we're also incredibly interested in hearing your thoughts and feedback. But we want to start by saying that this was inspired on Loot principles. So for those of you who are not familiar with it, Loot is an NFT game of a new generation of games that are played on chain. And it was really interesting to us because it's not a regular game. It's an open-ended crypto game. It's more like we're selling the deck of cards, and then it's up to the people to decide which game to play, whether it's blackjack or poker or something else. But there is a distinction between the deck of cards and the game that is being played with those cards. We were also inspired with this idea of generative NFTs that allow the minter to become entangled with the token itself. There is a random element in the token that means that the person that minted it was actually crucial in the outcome that ends up being created, including different levels of rarity, which I'm going to talk about in a moment. And then finally, as I said, the idea is that the game and the players are on totally separate levels, and it's up to the players to decide how to play the game and whether they want to extend it or not, and how. So let me actually double click on this a little bit. We're actually going to leave a little bit of mystery around Potion Unlock, but we also want to give you just a sneak peek into how this is going to work. So here is us, the developers. We're going to take all the code that we've written, the audited smart contract, the front end, Potion Analytics, as well as all the testing, documentation, and audit reports. And we're going to store it in IPFS. But we're going to store it in an encrypted fashion. So we're going to encrypt this with a very long password, very long, very strong password. And what we're going to do is we're going to break up that password into small pieces. And we're going to get those pieces and we're going to embed them into NFTs. And we're going to create 10,000 of these NFTs. And these NFTs are going to be distributed through a number of public auctions. And at that point, kind of the power to bring the code to life will be distributed in the earliest community members. And it will be up to the community members to reach consensus and collaboration such that they can actually reunite the password, at which point the code would become accessible to the world. The game is actually fully featured. So we've actually developed a second Web3 application just to be able to complete the game. And the idea is that all these people, once they have somehow reached a consensus that leads them to want to reveal their secret, they're going to have a microsite, which is also really beautifully designed. And they're going to be able to authenticate that the secret that they hold is actually authentic and genuine. And in the process of verifying that authenticity, if it turns out that it is indeed a real password, then it will actually be revealed on chain such that that piece of password now is in the public domain. And provided enough people do this, then at that point, the password can be fully reconstructed and the code becomes open sourced. I hope the main ideas are making sense. So just to reiterate, the code will actually contain a fully developed, fully audited, fully ready to go set of code, including the smart contracts, the front end, which was developed in Vue, including the router, which, as Aureliano mentioned, in itself was a small feat of engineering, the Potion Analytics suite of tools, as well as the user documentation. So this is how it's going to work. We're not going to reveal just yet the designs for these NFTs. All I can say is that we personally think they're incredibly cool, but we're going to have different rarities. And these different rarities are going to have different levels of power. So there's going to be like an entry rarity, a middle rarity, and like a high-end rarity. The high-end rarity having the most amount of decryption power, and the lowest rarity having the least amount of decryption power. And here I actually want to make another announcement, which I'm also very excited to make, which is that we actually wanted to do this call with you guys without announcing it on Twitter, because we're going to be distributing a special class of rarity that we're calling OG rarity that belongs to you guys. So everybody on this call is going to be getting some OG NFTs. And this is in recognition for you guys kind of staying the course with us and keeping interested. I'm also happy to announce that the people that participated in the focus group calls are going to get an extra allocation. Like I said, we built this project for the community. And so to the extent that the community adds value to the project, it feels to us that that should be compensated. And in order to do this in a sound way and to avoid this distribution being gamed, we're actually going to take a small pause right now. And I'm going to direct everybody to our Discord such that we can confirm who was on this call, such that we can make that distribution successfully. So on the Discord channel, you will find a channel called WACME. And so for the next 90 seconds or so, I invite everybody on the call to come onto this channel and to write the word WACME. And we're going to be using that later on to determine who is eligible for this distribution. So I can see that people went for it very quickly, which is great. So I'm just going to stop now for a few seconds and give time to people to list themselves. Seeing a lot of familiar names. It's really, really great to see all of you guys. Momo, let me take this moment to thank you in particular, man. Like the recent recommendation you gave us on the video production was like a godsend. So thank you so much, brother. Okay, so if you haven't done this yet, I suggest that you hurry, because I think in the next minute or so we're gonna close this, just to make sure that people don't try to game the system. So if you don't mind, I'm gonna switch over, and if I can ask somebody else in the team to moderate the channel in the next minute or so, that would be much appreciated. I saw some founders, by the way, some founder names show up in the call. It's really great to see you guys here, in particular members of the derivatives sector. So in summary, we think this is like a new release paradigm for projects. It's experimental. It has never been done before. We understand that it doesn't come without challenges, but we feel that we built it with the right spirit in mind. We're calling it aggressive decentralization, as in we want to be pregnant all the way directly. And we really want to realize this vision of this being a truly decentralized, truly community-owned protocol. We think it's a more sustainable business model for developer teams. It allows them to finance their operations and be compensated without taking life-risking chances. And importantly, and this is a really important point, it actually natively facilitates the bootstrapping of a community. If you think about it, all the NFT buyers are going to leave a trace on chain that is going to allow people to discriminate between who was an OG in the protocol versus who wasn't, and that feels like the seed for the appearance of on-chain communities. So in some sense, it's kind of aligning a lot of interesting goals and designs. We also wanted to briefly touch on kind of what's kind of the roadmap for us. So the last year and a half, as you can see, we've been incredibly busy. We've developed a brand new pricing paradigm, bottom up from scratch, trying to build something that was compatible with the particularities of the crypto markets. We've built a Web3 implementation that allows this to be natively accepted. And we've also come up with a new release paradigm that we've actually implemented. The not so great thing is that we've done all of that kind of privately behind closed doors. And that's kind of the first thing that we're going to change. So as we make this transition into this transfer to community ownership, we're going to be starting to work in a totally different manner, a lot more open, a lot more public, a lot more in the spirit of contributing. We don't want to be the center of the protocol. We just want to be a strong contributor to the protocol. And we absolutely invite whoever is interested in the world of risk management to participate and contribute. And we actually have some pretty specific ideas of what we would like to build for V2. We even built some prototypes already. And this should give you an idea for what we're chasing. We believe in this idea of expiration-less insurance. So you can think of V1 almost as a proof of concept for the bonding curve paradigm. But to the extent that this is proven correct, then we want to move away from kind of the more traditional option expiry system, which has a lot of friction. We want people to be able to say, I just want to subscribe to an insurance. And so long as my capital is in a contract, then I'm insured, right? And whenever I take it from the contract, then I'm no longer insured. That easy. I don't need to think about the rolling over and all that stuff. We also have some exciting ideas for an automated curve manager. So as we said, with Potion Analytics, LPs will be able to produce their own curves. We actually want to experiment with a smart contract that can actually, in real time, update those bonding curves to react to market conditions. And we also want to extend the supported instruments beyond puts or insurance and bring them into the realm of calls, spreads, and other structured instruments. So what's the timeline? As we said, this was a kind of internal OG call. This was for the people that are close to the project, that have been sticking with us. We thought that we owed it to you to kind of share the news with you first. We're incredibly interested in your feedback. But then progressively, we're going to start making all this information public to the rest of the community. Next week, we're going to have a Kelly machine post describing this discovery of the hyperbolic cosine function. And we're actually going to be releasing some how-to videos and some demonstrations videos of the web app. Unfortunately, it's not going to be available on testnet, because then it would defeat the purpose of the unlock game. If we deployed on testnet, then the code would de facto be already released. So people are going to be able to see it and see how it works and so on, but they're not going to be able to see the code just yet. The week after that, we're going to be releasing public information on Potion Analytics, including a number of videos. And on that week, we're going to have a demo day. So it's going to be the next call for the community, and we're going to be demoing live with you the UX and also the analytics tools, so that you guys will be able to use it. And I'm happy to say that actually the Potion Analytics, they're actually Python streamlets, and we're actually able to release them without revealing the code. So this is going to become available ahead of unlock. And then finally, 3 weeks from now, we will do the full disclosure of the unlock challenge with the final reveal of the artwork for the NFTs and details of the rarities and dates for the actual auctions. And together with these announcements, we will also be posting videos that will show how you actually mint those NFTs, and also how you actually reveal your password if you decide to do so. And on that week, we're going to have the third call ahead of the unlock release, where we're going to be discussing this in depth and taking questions from the community as well. And then finally, we're going to go live. and we're going to go live with these auctions that I discussed. We don't have fully confirmed dates yet. We're actually having conversations with a couple of regulators just to be 100% clear that that this is not a security and that open sourcing code is not going to be a liability problem for us. So I know that everybody has been waiting a long time for Potion, and so actually us as a team as well want to make sure that we release this sooner rather than later. And so, yeah, just to wrap up, I know this was a lot. You can see that we've been really busy, but I just wanted to summarize really quickly. We introduced this new paradigm for risk pricing based on hyperbolic cosines, and we're going to ship Potion Analytics, which is going to be a really simple tool for LPs to produce these curves. We've also completed the development of the Kelly machine, which is a Web3 implementation that natively supports the outputs that are produced here. And finally, we're also shipping a full-on Web3 crypto economic game that is going to allow us to distribute all the code that we've produced to the world in a way that is sustainable for the team and that hopefully is going to keep us out of jail. All right, so if there are no more questions for now, I just wanted to reiterate the thank you. I know that it took us a long time to get here, but we really wanted to be ready before we launched. I think we got there, and it's incredibly exciting to start now building together, guys, and building with you. And once again, I want to especially thank you guys, our OGs, and I hope you're going to be as excited as we are, and that together we're going to be able to grow the project. And with that,
really good. Can I ask
thank you so much,
question?
everybody. Yeah, of course.
One question. Thank you. I just want to say again, I've also been following you for a really long time. Must feel like the best part of a year now. And fantastic work, great guys. Really good.
Thank you.
On Discord, is it worth just setting up a channel that is limited to the OGs just as a starting point, and then we can branch off from there?
Yeah, absolutely. We will in fact do that, and we have all of you guys registered already on the WACME channel. Maybe that WACME channel is the OG channel, but yeah, absolutely, that's a good idea.
Awesome, great stuff. Thanks again, guys. Well done.
Absolutely. Okay, thank you so much, everybody. Looking forward to continue the conversation.
Thanks, guys.
Sneo, you can close the meeting now.